There is a belief, held with near theological conviction in the corridors of modern economic policy, that central banks must be independent from political control. It is written into the founding statutes of the European Central Bank. It is affirmed in the Federal Reserve Act, as decades of institutional practice have interpreted it. It launched the modern inflation targeting era through the Reserve Bank of New Zealand Act. And it is repeated by every major monetary authority in the developed world as if it were a law of nature rather than an institutional choice. The argument for independence rests on a deceptively simple premise. Politicians have short time horizons. Elected on cycles of 4 or 5 years, they face a permanent incentive to stimulate the economy before elections, to tolerate inflation today in exchange for growth that will be remembered at the ballot box. Left to their own devices, they will pressure central banks to keep money cheap and credit flowing, regardless of the consequences, producing a systematic upward bias in inflation over time. Independence is offered as the institutional cure, a constitutional firewall between the short-term calculations of democratic politics and the long-run requirements of monetary stability. It is a coherent argument. It is supported by a body of academic literature developed from the 1970s onward. And it has been the organizing principle of global central banking for the better part of 4 decades. It is also examined carefully against the historical record and the actual behavior of independent central banks. Largely a fiction, not a total fiction. The complete absence of any insulation between monetary policy and electoral cycles would produce identifiable pathologies. But the independence that actually exists in practice, the independence of the Federal Reserve, the European Central Bank, the Bank of England, the Bank of Japan, and the Swiss National Bank, is a selective, partial, and ultimately political independence that bears little resemblance to the pristine separation of powers described in central banking doctrine. Consider first where the doctrine came from. The modern case for independence was built primarily on a single intellectual foundation: the theory of time inconsistency, developed by Finn Kydland and Edward Prescott in 1977, and applied to monetary policy by Robert Barrow and David Gordon in 1983. The logic is elegant. A government that controls monetary policy faces a permanent temptation to surprise workers with higher than expected inflation. Employment rises, output expands in the short run, but workers anticipate the temptation, set their wage demands higher, and the economy spirals into persistent inflation with no lasting benefit. The solution the model implies is a commitment device, an institution insulated from political pressure, staffed by technocrats with inflation-averse preferences, that credibly removes the temptation. The Volcker disinflation of the early 1980s seemed to prove the point. A Federal Reserve willing to impose severe recessions to break inflationary expectations delivered outcomes a more politically exposed institution could not. But the model has significant limitations that its institutional adoption obscured. It assumes the primary monetary pathology is inflationary bias. It has far less to say about the opposite temptation: the temptation to keep money easy in the service of financial stability, asset price support, and government debt financing. And it assumes that independent central bankers have genuinely different preferences from political actors. Both assumptions have been severely tested by the past 2 decades. Neither has survived intact. Now ask a more basic question. Were central banks ever genuinely independent? Or was the doctrine always a post hoc rationalization applied to institutions whose origins were deeply, structurally political? The Federal Reserve, created in 1913, was the product of a political process that was anything but dispassionate institutional design. It was a reform sought by the banking system, the Morgan and Rockefeller interests, who recognized that a central bank with government backing could provide lender of last resort facilities a purely private system could not, and delivered by progressive politics as political cover. The Bank of England, founded in 1694, was born as an explicit quid pro quo. William III needed war financing he could not raise through taxation alone. City of London merchants provided the funds in exchange for a royal charter granting exclusive note issuance rights. It was a government financing mechanism dressed in monetary clothing. And the European Central Bank is perhaps the most candidly political of them all. It was created as the monetary expression of the European political project, the Franco-German compromise that made the single currency possible. The Bundesbank's independence, its model, was not a German political choice. It was an Allied imposition after the Second World War, retained because its inflation-averse outcomes happened to align with German preferences. The lesson is consistent. Central banks have always been political institutions, and their independence has always been conditional. The doctrine received its most severe stress test not in politically volatile emerging markets, but in the institutional heartlands of the developed world in the decade following the 2008 financial crisis. The quantitative easing programs launched by the Federal Reserve, the Bank of England, the ECB, and the Bank of Japan between 2008 and 2022 were, in economic substance, fiscal operations conducted through monetary institutions. When a central bank creates reserves to purchase government bonds, it finances the government at terms the central bank itself determines, suppressing yields, reducing the government's interest burden, and allowing deficits that would be politically impossible without it. In the classical doctrine, this has a name. It is fiscal dominance, the subordination of monetary policy to the financing requirements of the state. The Bank of Japan took this logic to its institutional extreme. Under Governor Kuroda, the bank adopted yield curve control, explicitly capping the yield on 10-year government bonds, purchasing whatever quantity of bonds was required to hold it there. This is, without meaningful qualification, direct monetization of government debt. And Draghi's 2012 commitment to do whatever it takes was an explicitly political act. An intervention dressed in monetary language, making clear the ECB would cross the line prohibiting government financing if the survival of the currency required it. The doctrine also assumes that central bank technocrats have preferences systematically different from those of political actors. That assumption deserves scrutiny in light of who actually runs central banks. The modern central banker is drawn from the same educational institutions, academic departments, and professional networks as the economists who advise governments and serve on the boards of the financial institutions whose behavior central bank policy most directly affects. Draghi moved from Goldman Sachs to the Bank of Italy, to the ECB, to the Italian Prime Ministership. Carney moved from Goldman Sachs to the Bank of Canada to the Bank of England. These are not exceptional biographies. George Stigler's theory of regulatory capture predicts that regulatory institutions are systematically captured over time by the industries they regulate, because the regulated industry has concentrated, ongoing interests, while the public has diffuse, episodic attention. Central banks are not immune. Their intimate professional relationship with the financial sector creates systematic pressures toward outcomes favorable to that sector. Pressures that are structurally prior to any explicit political interference. The post-2008 environment, sustained asset price support, suppressed interest rates that benefited leveraged financial actors and property owners, the willingness to absorb financial sector risk onto central bank balance sheets, produced its own distinctive distributional consequences, concentrated in the financial sector and the ownership class. Switzerland is, in important respects, the country where the case for independence is most credible. The Swiss National Bank has an institutional culture of monetary conservatism and a long history of resisting the inflationary pressures that eroded every major currency against which the franc has been compared. And yet, the SNB's own experience demonstrates the limits of the doctrine even in its most favorable environment. The decision to impose the minimum exchange rate floor of 1 franc 20 per euro in September 2011 was not a technocratic monetary decision. It was a political economy decision, a response to pressure from Swiss exporters and industrial firms for whom franc appreciation was causing severe commercial distress. The consequences: a balance sheet exceeding the size of the entire Swiss economy, the accumulation of enormous foreign equity and bond positions, and the violent adjustment of January 2015 when the floor was abandoned, were partly the consequences of an institution more responsive to the political economy of Swiss export competitiveness than a genuinely independent one would be. The SNB's 7 years of negative interest rates at minus 0.75% similarly reflected exchange rate management as much as pure price stability targeting. Negative rates were a tax on franc-denominated savings. Swiss savers bore the cost. Swiss exporters benefited. The distributional choice was a political choice made under the cover of a technical mandate. There is a deeper critique still, and it comes from the Austrian school. It does not merely argue that central banks are insufficiently independent in practice. It argues that the independence doctrine asks the wrong question entirely. Ludwig von Mises argued that sound money, money whose supply is not subject to discretionary expansion, is a prerequisite for the economic calculation on which market coordination depends. When the money supply is expanded, relative prices are distorted in ways that mislead entrepreneurs, generate malinvestment, and produce the boom and bust cycles that characterize credit money economies. These distortions are not the consequence of political interference. They are the consequence of discretionary monetary expansion itself, regardless of whether it is ordered by a finance minister or decided by an independent monetary policy committee. An independent central bank that expands its balance sheet by $4 trillion produces exactly the same distortions as a politically controlled one doing the same thing. The governance structure does not change the economic character of the action. Murray Rothbard put it more bluntly still. The central bank is not a solution to monetary instability. It is the institutionalization of that instability, a mechanism for allowing the banking system to expand credit beyond the level of genuine savings. What matters is not who controls the credit expansion machine, but the existence of the machine itself. Consider, finally, the most reliable empirical test. It is not what happens during normal conditions, when the costs of independence are low. The test is what happens during crises, when the costs of monetary discipline become acute and political pressure to abandon it becomes intense. The Fed's capitulation to political pressure in the late 1960s and early 1970s is the canonical demonstration. Arthur Burns operated under sustained Nixon administration pressure to keep monetary policy accommodative ahead of the 1972 election. The Nixon tapes contain explicit discussions of the pressure applied. The monetary expansion that followed contributed directly to the inflation the independence doctrine was subsequently developed to prevent. The ECB offers a contemporary version. German members of the Governing Council have consistently voted against the asset purchase programs and negative rates they regard as inconsistent with the price stability mandate. They have been consistently outvoted. The ECB's governance aggregates the monetary preferences of 19 political economies. This is not independence from political pressure. It is the institutionalization of political pressure in a supranational setting, with the appearance of technocratic decision-making providing legitimacy. So what does the doctrine actually protect, and at whose expense? What it protects most reliably is the autonomy of central bank technocrats from democratic accountability. The same insulation that prevents elected politicians from ordering inflationary expansion also prevents democratic institutions from scrutinizing decisions that impose severe distributional consequences on populations that had no voice in making them. The decade of near-zero interest rates and quantitative easing that followed 2008 was a policy of extraordinary redistributive consequence. It transferred wealth from savers to asset owners, from young people trying to buy homes to existing property owners. These transfers were not voted on. They were decided by committees of technocrats operating under mandates that did not require them to account for distributional outcomes. Central bank independence, in the end, is not a principle. It is a preference for a particular institutional arrangement, justified by a particular theoretical framework, sustained by a professional class with particular interests in its continuation, and conditional on a political settlement that treats the arrangement as beneficial. That preference is not without merit. The historical record of fully politicized central banking, the Weimar Reichsbank, the pre-Volcker Fed of the Burns era, provides genuine cautionary evidence. But the choice is not binary. The independent arrangement has its own distinctive failure modes. The time inconsistency of asset price support rather than consumer price stability, capture by the financial sector, the accountability vacuum that insulates distributional decisions from democratic scrutiny, and the structural inability to resist fiscal dominance when the stakes are high enough. The honest accounting begins by admitting that the firewall was never as solid as the doctrine claimed. This is Game of Franks. The full article, with the charts, the data, and the methodology, is at gameoffranks.com. Subscribe for the next one.